And that is your closing bell. As Jared said, they're the end of a great quarter. Unfortunately, ending in the red today as we look across the major indices to see where they settled on March 31st. The Dow down about 1.5%, down 550 points. The S&P 500 down about 1.5% as well, down 71 points, almost 72. And then the tech-heavy Nasdaq down 221 points, also ending in that same range of about 1.5%. So let's see what happened in those final few minutes and what we make of the market trends that we saw today with our market panel. Stuart Russell, YieldX's Chief Investment Officer, and Robert Cantwell, Up Holdings Portfolio Manager. So Robert, I'll start with you in terms of any sort of signals that you're reading as we now end this quarter. What do you think were the most notable things coming out of it?
Well, I think investors are very happy that that quarter is over. It was a tough one. Obviously, inflation was bad all the way up until the end of the quarter, and it's in all likelihood, the next 4 to 6 weeks, it's likely to continue to be bad news because inflation is persistent and we're still comping record growth rates from the first 4 months of last year. That said, as you get to the second half of the next quarter, you could see a scenario where growth rates start accelerating again while inflation tempers. And that has the potential to bring a lot of the bulls back into the market.
And Stuart, I mean, thinking through more about the inflationary picture right here, the Fed has already said in its most recent meeting as well that they're going to be watching closely for inflation to likely take longer than expected to return to their price stability goal. You know, what is that timeline that the markets are pricing in right now?
Sure. Well, the markets are pricing in meaningful Fed tightening over the next year and a half between the 300 basis points of rate hikes that are priced in by the middle to late part of 2023, and then the balance sheet reduction, which will probably commence sometime over the summer. The markets are expecting the Fed to start removing accommodation, doing it relatively quickly and meaningfully. At YieldX, we think that these moves have certainly put a lot of interesting opportunities into the fixed income market. So what the Fed is doing is certainly on a one trajectory of raising rates and tightening monetary policy, but we also think that there's a lot of opportunities that are opening up in the fixed income markets.
Robert, you mentioned the first negative quarter since Q1 2020, some mild inversion of the yield curve earlier this week, prompting a little bit of recession talk. But you say reacceleration is more likely than recession. Why?
I do. A lot of investors forget that the first half of 2021 was the strongest growth that the U.S. has experienced in the last 50 years. That is a phenomenal statistic and a very, very difficult one for companies to compare against in the first half of this year. Now, that said, with every passing month this year, you see those comps get easier and easier. You have to remember, when we're looking at those inflation numbers, those are year over year numbers. Those are not month to month numbers. And we're already seeing that month to month price increase start to hit a little bit of a ceiling. So there is the potential, as we noted, that there could be improvement there. And with stocks like Meta trading at 10 times operating cash flow, this is exactly one of those environments that you look for where there's a tremendous amount of fear, but really attractive security prices to potentially start participating in some of these growth names.
And Stuart, as you look at some of the mega caps, if you look at something like a Meta, is this still looking attractive to you right now as well?
Well, we're more focused on the income market, so equity income and fixed income across the board. So we are seeing a lot of opportunities, similar to what you've seen with some of the large cap stocks throwing off a lot of value signals. We're seeing the same thing. High yield, for instance, we're seeing spreads out and yields out to the point where you could put together 6% yielding portfolios that have very attractive yield and risk characteristics. So, not particularly in the equity names, but in the fixed income universe, we see very good opportunities.
Robert, I want to come back to something that you mentioned a moment ago in the year-over-year comps. At what point do you believe that we'll steadily get back to some of what's now going to be perhaps a year-over-3 comp, pointing back to some of those pre-pandemic norms? And for which companies do you see them getting to those first?
Well, it's funny you asked that. Stuart and I are clearly in very different businesses because a 6% yield in a 6% inflationary environment means I'm getting paid nothing. And, where we're investing capital is we're trying to set that capital aside and compound it at double-digit rates for multi-year periods so that we can actually gain earnings power over multi-year periods. Now, to the specific of your question of when do the comps get easier and easier, we see that starting after the 6th week of the quarter. So right when earnings season starts in just about a month. And so starting with, Netflix is almost always the first to report. You're going to hear from Netflix. Netflix could actually have negative subscriber count number this quarter. The comps are that difficult right now. However, by the time you get to the end of earnings season, 2 months from now, it's very possible that you're going to hear companies talking about an acceleration in their growth rates relative to the numbers that they had to post last year. And we see the inflation targets following a very similar trajectory of those comps getting really easy when you get to the back half of the quarter.
Stuart, if you can't talk commodities, given everything we're seeing with the Russian invasion of Ukraine, are there opportunities out there?
Yeah, absolutely. The Russian invasion of Ukraine has created an incredible uptrend in all commodities, from energy to the grains and wheats and barley, really right across the board. And we think that'll probably continue as long as the tensions in Eastern Europe continue. And that's just another thing that is putting the Fed on the course to raising rates. And we think that it's having a meaningful impact on the macro markets and one that'll continue.
All right, Stuart Russell, YieldX Chief Investment Officer, as well as Robert Cantwell, who is the Upholdings Portfolio Manager. Thank you so much for closing out the quarter here with us after the bell here. Appreciate the time and the insights. Got to have you back and continue the conversation.